This is Retirement News Online. Overspending, investing too conservatively, and veering away from your plan, these are some of the most common traps you can fall into on the way to retirement. Now, the good news is you have the potential to avoid them with a little discipline and forethought. Other risks like health crisis or market downturns can't be avoided, but you can employ strategies to help manage them. Here to talk about this is Darrick Wilkins with LTCtree.com. Let's talk about longevity risk. That's the risk of outliving your money. How do you handle that?
Yeah, longevity risk, it's a reality, and a lot of times it's an overlooked reality because modern medicine has prolonged people's lives over the past 100 years. We've probably added a decade or two to people's lives. And, most people, if they retire at 65, if they live to be 95 like their mom or dad or grandparents, that's another 30 years of money that's going to have to come from somewhere. And it can come from a pension, but pensions, that's kind of a dying animal. A lot of companies don't even offer a pension anymore. You have Social Security, and a lot of people are concerned, is Social Security going to even be there? And then the third area is you got to plan for yourself, and that's where these equity index annuities come into play.
Market volatility is something that we can't really avoid that, but how do you handle market volatility in terms of something like sequence of returns risk?
Yeah, and just to take a step back, we love the stock market. I love the stock market, and we always advise our clients to have the bulk of your assets in the market, but there's a portion of the assets, whether it's 30, 20, 10% of the portfolio that can be allocated towards these equity index annuities, and it guarantees you a floor that you're not going to lose principal if the market goes down. Just if we've seen in the past 4 years, we've had some big spikes. Spike up during COVID, spike down, and then 2022 we had the Ukraine war, and the S&P was down 30% that year. And so for a portion of the assets, that's where these equity index annuities come into play. It kind of takes that volatility out. So the downside of equity index annuities is you got to give the money to the company over a period of time and agree not to take it out, whether it's 5 years, 7 years, 10 years. But the benefit is if the market goes down, you get a 0% return that year. You're not going down 20%.
So do these products have any liquidity?
Yeah, liquidity, that's a great question. And most of these products will give you a 10% liquidity of the contract value each year for the first 10 years. After 10 years, you can walk away with all your money if you wanted to. And so they are liquid. There are some products that will give you 20% liquidity if you didn't take out your 10% the previous year. So they are liquid. And if you think about it, if you're taking out more than 10% of the money from that investment, you start drawing down principal. So typically people take their income in 10% increments or less anyway.
Now, Social Security provides, cost of living increases to, hedge inflation. What about these products?
Yeah, so these products are indexed to common, S&P, NASDAQ type indices, which the goal is those indexes are going to grow at a higher clip than inflation. And so it's, we've had some clients get some, double-digit returns. You're not guaranteed to get that, but you are guaranteed to not lose principal. So the goal is for these products to outpace inflation, so your portfolio does keep pace with inflation, if not exceed it.
That's Darrick Wilkins with LTCtree.com, and this is Retirement News Online.